Watch and learn the famous words by David Hunter. A melt-up is just ahead, likely to be the biggest, steepest rally in the post-World War II era, and will be a broad rally with both growth and value. Large and small caps participating, commodities, industrials, tech including FANG, semis, and ARC, autos, airline, steel, financial, and miners will all play. Hey, if he's right here, that we got to be a part of that. But lately, the market has been acting crazy. The three-part story over here. You click to go long, the market goes crazy, and then you're praying that your ship doesn't sink. And I tell you what, the market, where do you go for safety? We had a big gap up, it ripped up, and then just sold off the remainder of the day. This is what takes place in bear markets. That's just what it is. So when will this market turn back around? We're going to go over some key levels and some key insights of what's taking place, where some of the safety trades are, and just kind of revisit also these expected moves that we talked about on yesterday's episode. This is the Stock Market Brief Show. My name is Michael Silva. If you're new here, well, welcome to the channel. Make sure to hit that thumbs up button and subscribe. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Let's get into it. Alrighty, everybody, welcome back. We are looking at the 11 sectors that make up the S&P 500. Energy caught a bid. Makes sense, right? It was down over 3% yesterday, so to see this, catch a little bit of a bid makes a little sense to me. Is this going to hold? I'm not 100% sure. It was up more throughout the day, but then kind of sold off. Many of my trade ideas that I posted in the Discord yesterday were energy names. I'm pretty sure close to every single one of them were up, just like many of these oil stocks were. But here's what's concerning is when you take a look here, you have utilities also continuing to perpetuate to the upside here, being one of the top performers. Then you have consumer staples as well. Consumer discretionary also was up there. A little bit of a mixed board as we're coming into, obviously, earnings week here. If you take a look over here, the S&P 500 and pretty much across the board was down other than small caps. We did discuss small caps being the opportunity today and potentially even to tomorrow, which we'll touch on. But, where do you go for safety here? These numbers don't really reflect how volatile the market was, right? If you just look at the end of the day and you're like, oh, it was only down 0.34. Well, yeah, but it was up tremendously on a big gap up, went even higher, and then reverted throughout the day. So volatility was absolutely incredible. Now, what else is taking place in the markets? The dollar. The dollar continues to move up higher and higher. So where do you go for safety? Well, it seems like the dollar is there, right? This looks like it can take a little bit of a breather here soon. This candle gave us that insight, but these last couple of trading days, it continues to perpetuate up. And as we've been saying, if this broke out and you see strength in the dollar at a rapid rate of change, that could put pressure on the equity market and various commodities. And as it stands right now, commodities are holding up rather well, but yet the market is kind of, just rolling itself over, and we still haven't had, a successful back test of any sort, right? We ripped up, and now we're just been sinking here slowly. All right, now I want to bring up the VIX. I haven't brought up the VIX for a minute. 30-minute time frame. We have a gap beneath us, gap above us. This right here looks like a bottoming type structure, right? Clear resistance here at around 25. Okay, this could be potentially a little inverse head and shoulders. If we start busting out of that, that'd take us pretty much right up to around 30 to 30.5, and that's where pretty much anything could fall apart, right? So you might not find safety in utilities, you might not find safety in, consumer staples, because when the VIX gets above 30, everything could get hit. Miners, gold, silver, anything could get potentially hit. So you got to be very careful when the VIX climbs up to those levels. Now, if it does hit those levels, start looking at this as an area where it can act as resistance, okay? So as it stands right now, we do have a low, a higher low, a higher low. If this starts breaking out, we might get a sudden pop, and we just need to be mindful for that pop. If you take a look at the safety trade here, gold, utilities, consumer staples, TLT, which we'll talk about, defensive names, and healthcare relative to the S&P 500, right? They're all pointing up here. So they've all been doing good. We've been talking about gold being a potential play. TLT, it's starting to actually take a little bit of a breather here going sideways, which tells me, hey, perhaps the relative strength could potentially pick up here as it's been getting completely hit to the downside. Now, we'll see here if the 10-year yield wants to back off. And if it does, I think that this is going to start turning up and we'll start to see TLT outperform the S&P 500. It just hasn't done so right yet. And as it stands right now, it's kind of technically like catching a falling knife. So we got to be careful there. What else is playing out well? Well, silver did take off. It was up almost 3% today, right? We talked about this previous candle and we said, it's don't be too concerned about it because it was a higher high and higher low, a higher close there, and it could be somewhat of a fake out fade. And today we saw some strength. Now keep in mind, I don't have the risk range of it here, but it's right back up at the upper risk range too, which means that it could be potentially taking a break around in this area. But you know, that was a very strong move out of this wedge. And if this is actually a real breakout, right? The volume's good. We have a bullish crossover. You know, I feel like it's very possible to retest this 2750 in the matter of, in a short period of time, potentially even higher. So I'm keeping my eye on some of these miners and obviously gold and silver. Speaking of gold, let's go to gold. Gold also, bam, concerning candle, and then big move today, up 27.9, which is 1.43%. Bullish crossover taking place. It broke out of this little trend line, right? Bam, good volume. So far, so good. This looks like it's going to be a top performer here. So far, it is a good performer in the start of the second quarter here. So we'll see if that continues to be the place of safety and alpha, to generate alpha here in the second quarter too. Take a look at wheat. So we talked about this a few episodes ago. Wheat potentially showing a good setup, and then not even just wheat. We also looked at corn. So corn right here looks like it's about to be breaking out of this pivot. We do have that bullish crossover. We have some volume coming in too. If you don't trade corn futures, you can always look at the ETF. I believe it's just ticker symbol CORN. If you're interested in trading something like this, but clearly it's holding up right now. So if you're looking for relative performance, relative strength, those are some areas that I'm keeping an eye on. Various commodities, right, and obviously the dollar too as well. Now, oil continues to be super volatile, up 6.69% today. We did get CPI data, and it seemed like it was good right out of the gates, and then the market reversed. I'm not going to touch too much into the metrics of CPI. I prefer just watching what the market does and how it digests the information in the days ahead, coming into obviously earnings. So we'll see here if this was what we were kind of discussing, where it could be just a bear trap and then we just rip higher. As it stands right now, we're back above that 50-day moving average, but we're still below the 20, have some room to go. If this thing fires off, I believe that a lot of these oil stocks will probably continue to just rally higher. Some coal stocks look really good. Some oil stocks, they look really good. They were coming out of some tight patterns today. So it was a good catch if you were a part of that trade. All right, a little bit of concern here. We have the summation index. We did get the parabolic SAR to uptick right here, and this is starting to curl itself back over. Let's see how long that holds, but this could be the start of obviously trend shifts, right? So when we get the purple, the SAR to start above it, it does tell us when there's a potential shift in the change of momentum here with the summation index, and this could be the start that we could see continued movement to the downside. Nothing really good happens with the summation index below zero, right? You have to be tactical, and as you can see, when we cross down through here, really, obviously it's been a chop fest all the way through. We try to get back above, but it just hasn't been all that great. So until we start seeing some strength there would be, a little bit better. And then you could take a look at a couple other indicators. These are the ones Michael Guyad uses. Lumber to gold ratio is still pointing down, which tells us what? Keep your foot off the gas. Probably better to look for more low beta equities. So, UUP, for example, XLU, XLP, and the various commodities that we've been seeing that are holding up from a relative basis. And then you take a look at the beta rotation indicator right here. It's also on that risk off category. So overall, we just foot off the gas, right? It's not the time to be a hero right here. Clearly, it's not the time to be a hero because the market's not setting up in any particular direction right now. It's just very volatile. And it does seem like it's going to be like this for the majority of the year so far, right? It just hasn't let up at all. If we take a look at financials sector, this was kind of moving up. We said it could be potentially a bear flag. It cracked down. Now we do have earnings. I believe JPM is reporting tomorrow, and BlackRock, if I remember correctly. If we start heading down, look at financials just below 37. That's that lower risk range there. If we take a look at JPM itself, JPM, once it reports earnings, it's pricing in about a $6 move. So look for when it does report hitting one of these levels right out of the gate, because if it does come down here right away, that would also be in confluence with this area of support, and that might be potentially a red to green type of day where we might see some sort of recovery, or if it gets outside of it, we might see a bounce. And that's typically what happens more in bullish environments. When it's bearish, you typically get a gap up and then it sells on itself. So if it does gap up way up here, be aware that that's kind of what the market already priced in, and it might not have much more upside right out of the gates, at least for the remainder of the week. Okay, so let's go ahead now and hop and look over at some of the risk ranges, and then I'm going to hop into the 15-minute timeframes for the indices. Okay, so I want to point out a couple of things here. So first and foremost, Dow Jones tagged that lower expected move, came outside of it, moved up a little bit. Look, if you're trading these type of things intraday, this makes sense to look for plays like this because they have been working quite well. Facebook is at the lower risk range. It closed right on there. If we take a look at gold, keep in mind, gold is at its upper risk range, right? So if this takes a little bit of a breather, can we be too shocked? No, absolutely not. We still have 2 more trading days left in the week, but it is right there at that upper range. If you take a look at Google got extended further out. Now take a look here. We talked about Google being potentially a good trade. Well, it gapped up, so it's too late at that point. What do we talk about with the SPY? I'll get actually into that here momentarily, but a huge gap up in Google reverted completely on the day. So I think it's more than possible that we come retest that lower risk range. So that is something that I'll be keeping an eye on. If we take a look at IWM hasn't gone really anywhere for the week. So relative strength is holding up quite well. And we have 2 more trading days left, a big open range. This thing could fire off in any direction. As it stands right now, it looks fairly bearish given the current candle and how the 50 period held. I think that if bank earnings come out, if the market interprets it as good, I feel like this can come right back up to the upper risk range. But if we do not get the greatest report and banks start to get hit and other things get hit, I think IWM could definitely head lower, especially if we take out the low of the previous trading day. Let me keep on going here. Microsoft also would be another one to keep a close eye on. Got hit big again. So take a look. We gapped up, right back inside the risk range, and then we came back outside of it too as well. So is it possible that we come back up here? Absolutely. So keep an eye on that. This is not the type of stuff where I'd short right now. This is where you'd be looking to take profits if you're short and then wait for another setup again. And it did come this morning where it came back in the range and then started selling off. But not too many people may have wanted to short on a big gap up like that, rightfully so, because that could potentially turn into a trend day. NVIDIA too, right there at that lower risk range. Nice move up into the middle of the range, sold right back off. But where are we? Take note, we're at that lower risk range and at a previous area of support again. Remember, it could just noodle around the lower risk range for quite some time. Now take a look at the Qs. Qs closed right on it. So we came outside of it. If you traded it intraday, bam, it moved up a little bit. So closed right there on just spot on to that lower risk range. SLV is right there at the upper risk range, so be careful of that. And when we have semiconductors, right? Semiconductors still has some room to potentially head lower. So this is SMH, can hit that lower risk range, so be mindful of that. If it does hit this lower risk range and that brings down, NVIDIA goes a little bit further. Notice how NVIDIA is already at the lower risk range. I think NVIDIA could be a good intraday trade if this comes down here and NVIDIA goes down with it. But as this ETF hits down here, I think NVIDIA could be that would be the timing for a potential good trade. And then SPY is outside of this lower risk range. Be very mindful being outside of this going into earnings, because if the big dogs, right, the big time traders have to hedge or sell into more selling, this right here will fire volatility up. So volatility will get crazy. It will rocket up. And we talked about that chart earlier. And if that's the case, we can obviously get even more of a stretch down here. Okay. TLT, I'm not going to touch too much on that. It didn't do much. Tesla is also right there, right around that lower risk range. And then also to take note, the biotech ETF XBI tagged it and then moved right up from there. So a lot of these big names, they have been tagging the lower risk ranges. XLC is holding down there too as well. Let's go into the 15-minute timeframes now. All right, so we're taking a look here at the SPY. We do have a little bit of a falling wedge structure with a positive divergence. So I think it's more than possible to come back up and potentially even retest the 5-day moving average. We need to recoup this. I've seen a lot of times where the week finishes closing right at the 5-day moving average. So that is something to potentially watch out for, or potentially this gap fill here. So that is kind of where I'm keeping my eye on. Let's go to the Qs. The Qs, very similar, falling wedge structure below a declining 5-day moving average, positive divergence. Keep an eye out for a potential breakout here as we're right there at that lower risk range. Keep also an eye right here at this volume shelf profile. right? So, price action's been trading sideways. Right here, this volume shelf profile can act as a magnet. So it could very well pop right back up, which right around that 5-day moving average, that can act as an area of resistance. If we take a look at the IWM, we talked about the falling wedge yesterday, burst right out of there today, ripped up higher. But remember, we talked about the declining 5-day moving average. Well, it held, and you can see here it started rolling itself right there back over. All right, everybody, that's all I got for you on today's show. We talked about a lot, okay? We talked about the various commodities and the dollar, where we can potentially see safety. As it stands right now, you need to be very good at finding setups that are in contraction. And what do I mean by that? Well, the market moves between expansion and contraction. Most patterns do that, okay? Expands and then price action contracts. When you have a contracting pattern or you have price action that's tightening, it allows for a better risk to reward, and that is what you need to do to really mitigate risk. But as it stands right now in the broad indices, it's just flying back and forth and just kind of sticking within that expansion kind of zone. So continue to be careful out there, continue to be patient. I will see you back here on the next episode.